In this lecture, we'll be looking at different types of stocks. Many of the things learned today are related to previously covered material, such as capital gains and dividends. We will also be going through common and preferred stocks, as well as their different classes. When you choose to buy a stock, you have the choice of buying two kinds of them, common or preferred. All publicly traded companies issue common stock, and some others issue preferred too. In terms of losses, you could say that preferred stock exposes you much less to the risk than common stock. On the other hand, it does give you much less potential for total return. Total return basically means the capital gains and the dividends you receive from an investment. When you hold common stock, you will most definitely feel the ups and downs of the company, as their share price would rise or fall continuously. They reflect the investor demand and the state of the markets. There are also no price ceilings, so the share price could possibly triple, but also lose that value. It is possible that the issuer of the common stock pay dividends, but it is not required to do so. And if it were to, the dividends wouldn't be guaranteed. The company could even cut or eliminate the dividends, though it would be a rare scenario, as it would send the wrong message about the company's financial health. When you're a holder of preferred stock, you're usually guaranteed a dividend payment. More importantly, the dividend is paid out before the dividends of the common stockholders. Unlike common stock, the price of preferred stock doesn't move as much though. Something interesting to look at is when a company goes bust or bankrupt. In that scenario, the priority and obligations go first to the preferred stockholder before the common stockholder. So in a very basic way, you could say that if you're in search of capital gains, then you should go for a common stock. But if you prefer dividends, then preferred stock is for you. Let's illustrate everything. So Joe is back for round 3. He's got his eye on Apple this time. He's decided whether he should buy its common stock or preferred stock. Joe's around 50, and he's looking for a stock that he can hold until his late 80s. In this case, since he's willing to buy and hold the stock for so long, it would be recommended that he go for the common stock, as he will experience a larger gain through his capital gains. Buying preferred stock would apply more to him if he were 60 years old, and he was looking to live off passive income, as we call it, which is basically dividends. There's another classification of stock. In addition to the choice of common or preferred stock, some companies may offer a choice of publicly traded share classes. These classes are designated by letters of the alphabet, usually A and B. A company may offer a class of stock which is reserved for one of its divisions, like another company it might have acquired. In another case, a company might issue different stock classes and have them trade at different prices and have different dividend policies. When a company has dual share classes, it's more common for one share class to be trading publicly while the other one is non-trading. Non-traded shares are usually kept for the company founders and management. Those shares are kept under tight restrictions from being sold, and they tend to have what is called super voting power. This way, it makes it possible for insiders to own less than half of the total company shares, yet control the outcome of issues that are put in shareholder vote. For example, a decision to sell the company. In order to recap everything, common stocks have to do more with capital gains, and because of that tend to have much more risk than their preferred counterpart. Preferred stock is more in relation with dividends and is consequently a much safer investment, but with limited upside. Stock classes are just classification of stocks and are used differently according to the company. So this concludes this lecture. I hope you enjoyed. Thank you very much.